4.3. Restate two key financial statements. It sounds extraordinary, but it's a fact that balance sheets can make fascinating reading. Mary Lady Archer, British scientist. The two other financial statements we will restate are the balance sheet and income statement. It is usually not so straightforward to restate these two financial statements. In fact, you may find it a rather slow and frustrating task at times. I will take you step by step how I did this for Ryman Healthcare. There are also some great videos where Maria Tyler takes you step by step how she restated the financial statements for Wesfarmers, restating the balance sheet and restating the income statements. While watching the videos, you can restate your own firm's financial statements. You can stop and start the videos as you do this. Restating your firm's financial statements for the first time can be a fascinating, infuriating, and fun challenge. Your firm will be different to Ryman Healthcare and Wesfarmers in many ways, as all firms are unique. No two firms are the same. You will need to discuss with others about their restatements to help you make judgments about all the issues and difficulties you might find. And make sure you check out our unit Facebook page. You can search our unit Facebook page by keywords. You'll find most issues you will have with restating your firm's financial statements will be discussed in our unit's Facebook page. You are free to do this and to share your draft work with others, as everyone's firm is different, so no one can simply copy each other's work. We all need to think for ourselves and make our own judgments. There is no other way. There is no simple cookie-cut solution for all firms that you can simply memorize and reproduce. It does not exist. You'll find the quality of the restatement of your firm's financial statements will be greatly improved if you work with others in the unit rather than try to do it alone. As Jessica Smith, a past student in our unit, says, "Do not be a lone ranger." Jessica submitted short videos for the steps in her assignments involving her key concepts and questions, KCQs. You can complete these steps using any format you wish. Everyone will be facing the same issues as you, just with different firms. You can help each other out and work together cooperatively as you seek to solve the problems you will each face in restating your own firm's financial statements. For after all, learning is a social activity. Take the opportunity to experience what it is like to learn in a cooperative social environment. Discuss issues with each other and share in the collective wisdom of our diverse, wonderful and interesting group of people from across Australia who are studying accounting with us this term. This will help us meet the challenges we will all face as we look carefully at each item in our firm's financial statements and decide whether it is an operating or financial item. Balance sheet. To help separate the operating and financial assets and liabilities of a firm, we restate its balance sheet, also often called its statement of financial position. A balance sheet normally shows all the assets of a firm, both operating and financial, categorized as either current or non-current assets, and all the liabilities of a firm, both operating and financial, as either current or non-current liabilities. This way of categorizing the assets and liabilities of a firm can be traced to the influence of the banking sector in the early development of financial statements. It facilitates an assessment of the long-term and short-term liquidity of a firm. It does little to help us view a firm from the perspective of equity investors and to clearly distinguish between the operating and financial activities of a firm. Our purpose in restating the balance sheet is to clearly separate operating and financial assets and liabilities, and to clearly identify net operating assets, NOA, as well as net financial assets, NFA, or more commonly, net financial obligations, NFO. Ryman Healthcare's balance sheet and its restated balance sheet are shown below in Table 4.5 and Table 4.6 respectively. As can be seen from Table 4.6, I have allocated the various assets and liabilities from Ryman Healthcare's balance sheet between operating and financial activities. If we have a clear idea of the difference between a firm's operating and financial activities, this in practice This is, in practice, a reasonably straightforward exercise. Usually, we can readily identify whether each asset and liability in a firm's financial statements is an operating or financial item, although sometimes we may need to look at the footnotes for some items to better understand what it is. It is also possible that as we look at the footnotes for some items, we may decide that part of the item is operating and part is financial. I find the best way to separate a firm's operating and financial assets and liabilities is to go to the balance sheet in the financial statements worksheet in our spreadsheet and put an O for operating or an F for financial next to each asset and liability. There is no need to do this for the items of equity. You will see in Figure 4.2 below how I have done this for Ryman Healthcare's consolidated balance sheet. I have put an O next to each of the assets except for cash and cash equivalents, where I've put an OF to indicate I will allocate it between operating and financial. You'll see I did the same for each of Ryman Healthcare's liabilities, with some liabilities being O and some F. Often one of the more difficult items in a balance sheet to restate is cash. A firm needs some cash to conduct its operations. It will never be possible for a firm to exactly match its cash outflows, for example cash payments to suppliers, with its cash inflows, for example cash receipts from customers. For example, a firm may need to pay its suppliers on a Monday, and cash receipts from customers may not come until Wednesday that week. For this reason, a firm will need some cash, either actual cash, for example in cash registers, or cash balances in the bank, or an overdraft facility with a bank to help it manage the cash outflows and inflows of its normal business operations. In such cases, a firm's cash or bank overdraft would be an operating item. However, a firm could also hold cash balances in the bank as a store of value that is not needed in the actual operations of the firm. In such cases, it would be a financial asset. It is similar at a personal level. We can keep some cash we do not need now in a savings account to earn interest and to save for some future use, a financial asset. And we can also keep some cash in a transaction account to use on a day-to-day basis to buy things with our debit card, an operating asset we need for our operations of daily living. Typically, it is not clear from a firm's financial statements how much of any cash balances are needed in the operations of a firm, and are operating assets or operating liabilities if it is a bank overdraft, and how much of any cash balances are simply financial assets. Where a firm has a relatively low level of cash balances, my advice is to include these cash balances as an operating asset and assume they are needed to conduct a firm's operations. What amounts to a relatively low level of cash would depend on the nature of a firm's activities, but typically up to about 1% of its sales might be an appropriate level of cash for many businesses to hold to help conduct their operations. You'll find some firms have large amounts of cash, sometimes amounting to many hundreds of millions of dollars. If your firm has a large level of cash balances, say more than about 1% of sales, my advice would be to allocate a small amount to operating assets, say up to about 1% of sales, and allocate the balance to financial assets. The key benefit of restating a firm's balance sheet is to clearly identify the firm's net operating assets, NOA, and net financial obligations, NFO, or alternatively net financial assets, NFA. For example, we can see from Table 4.6 below that as at 31st of March 2020, Ryman Healthcare had net operating assets, NOA, of $4,036.3 million, and net financial obligations, NFO, of $1,735.3 million. Income statement. Our purpose in restating the income statement or statement of financial performance is to clearly separate operating and financial revenue and expenses, and to clearly identify operating income after tax, OI, and net financial expenses after tax, NFE, or alternatively net financial income after tax, NFI. Ryman Healthcare's income statement, comprehensive income statement, and its restated income statement are shown in Table 4.7a, Table 4.7b, and Table 4.8 below. To restate a firm's income statement and comprehensive income statement, We first go through each item of revenue, expenses and other comprehensive income and allocate them between operating and financial activities. This is often straightforward, as we usually have enough information in a firm's financial statements to do this allocation. I find the best way to do this is to go to the income statement in the financial statements worksheet in our spreadsheet and to put an O for operating or an F for financial next to each item of revenue, expenses and other comprehensive income. In figure 4.3 below, you can see how I've done this for Ryman Healthcare. In table 4.8 below in Ryman Healthcare's restated income statement, I've included for 2020 under other operating comprehensive income, gains on hedge of foreign-owned subsidiary net assets, 1.2 million, loss on translation of foreign operations, negative 5.7 million, and revaluation of property, plant and equipment unrealised, 0 million. I've included fair value movement and reclassification of interest rate swaps, negative 10.4 million, and deferred tax movement on interest rate swaps, 2.9 million, as items of other financial comprehensive income. These items were taken from Ryman Healthcare's consolidated statement of comprehensive income in its 2020 annual report. For many of these items, you may find yourself wondering what they are exactly. The names can seem quite exotic and strange. You can discuss with others, as many will have similar items in their firm's financial statements, and they will also be wondering what they are. Here is a short video on interest rate swaps. Also, losses or gains on translation of foreign operations can occur when a firm has overseas operations, as Ryman Healthcare does in Australia. Its overseas operations will keep its accounts in the overseas currency. For Ryman Healthcare, that is $8. Each year on balance date, the overseas subsidiaries' accounts are translated into the parent company's currency. For Ryman Healthcare, that is NZ dollars. As exchange rates are always fluctuating, this can lead to losses or gains. Allocate tax to the operating and financial components of the income statement. This is usually the most difficult step in restating a firm's income statement. Tax is a real expense of a business in exactly the same way as any other expense, such as salaries, rent, interest on its borrowings, or fuel for the corporate jet. We have also seen before that profit equals revenue, both operating and financial, less expenses, both operating and financial. But there is one difference with tax expense compared to other expenses. The amount a firm pays in tax depends on its level of profits. For example, in 2020, Australian companies generally paid tax at the rate of 30% on their profits, New Zealand companies at 28%, UK companies at 9%, Chinese companies at 25%, Hong Kong companies at 16.5%, and German companies at 30%. This means that the greater a firm's profit, the greater the total amount of tax it will pay, and the less its profit, the less tax it will pay. A firm's profit and its tax expense will depend on the level of both operating and financial revenue and expenses. The more interest a firm pays on its borrowings, the less will be its profit and the less it will pay in tax. Also, the more interest a firm receives on its financial assets, the more will be its profit and the more it will pay in tax. So if a firm increases its borrowings and pays more interest, it will increase its interest expense and reduce its tax expense. Alternatively, if a firm reduces its borrowings and pays less interest, it will reduce its interest expense and increase its tax expense. What this means is that a firm's tax expense will be affected not only by its operating activities, but also by its financial activities, that is, by how much money it borrows. For us to clearly separate a firm's operating and financial activities in its financial statements, we need to allocate tax to a firm's operating and financial activities. We do this by calculating how much tax our firm would have paid on its operating activities if it had no financial assets or liabilities, rather than what it actually paid after deducting interest expense or including interest income, and add this to the tax expense on our operating activities. We then make a corresponding and opposite adjustment to our net financial expenses or income for the tax impact of our firm's activities. To do this, we need to split our tax expense into two bits. We have seen when we restated Ryman Healthcare's balance sheet as at 31st of March 2020 that it had net financial obligations, NFO, of $1,735.3 million, on which it pays interest. This means Ryman Healthcare paid less tax as a result of paying interest on those borrowings. This was a benefit to Ryman Healthcare of having those borrowings. I calculated the tax benefit for Ryman Healthcare of its financial activities as follows. Tax benefit equals net interest expense times tax rate of the firm. In 2020, the net interest expense of Ryman Healthcare was $18.8 million. This is the difference between the interest it paid, financial expenses $19.3 million, and the interest it received, financial income $0.5 million. The tax rate of Ryman Healthcare was 28%, the New Zealand corporate tax rate in 2020. This means the tax benefit for Ryman Healthcare of its financial activities was tax benefit equals $18.8 million times 28%, which equals $5.3 million. We deduct this tax benefit of $5.3 million from Ryman Healthcare's existing tax benefit of $93.6 million to give a reduced tax benefit of $88.3 million. Most people will have firms with a tax expense, and so you will deduct the tax benefit from your firm's tax expense. This is the amount of tax, and in the case of Ryman Healthcare tax benefit, that Ryman Healthcare would have if it had not had the benefit of deducting interest on its borrowings. In other words, it is the amount of tax incurred, or in the case of Ryman Healthcare tax benefit received, on its operating activities without the benefit of its financial activities. But of course, Ryman Healthcare did not actually have a tax benefit of $88.3 million. It had a tax benefit of $93.6 million because it had the benefit of its financing activities that reduced its tax benefit by $5.3 million. We deduct the tax benefit of its financing activities of $5.3 million from Ryman Healthcare's net interest expense of $18.8 million to reduce its net financial expenses before other financial comprehensive income to $13.5 million. This recognises the benefit to Ryman Healthcare of its borrowings in reducing its tax expense by $5.3 million. When calculating the tax benefit for your firm, you need to use the corporate tax rate of the country where your firm is based. Also, the corporate tax rate can change from year to year. In recent years, there's been a trend in a number of countries to reduce company tax rates. These are the tax rates you can use when calculating the tax benefit for your firm. Global company tax rates. Operating income, OI, and net financial expenses, NFE. We are now in a position to calculate both a firm's operating income after tax, OI, and its net financial expenses after tax, NFE. Both these items are calculated on an after-tax basis. We can show it this way once we've allocated tax between operating and financial activities. I've carried out these steps for Ryman Healthcare in Table 4.8 below, calculating in 2020 operating income after tax, OI, of $273.7 million and net financial expenses after tax, NFE, of $21.0 million. We have seen how to restate a firm's financial statements to clearly separate the operating and financial activities of a firm. This has allowed us to calculate Ryman Healthcare's 2020 net operating assets, NOA, of $4,036.3 million, net financial obligations, NFO, of $1,735.3 million, operating income after tax, OI, of $273.7 million, and net financial expense after tax, NFE, of $21.0 million. Along with an estimate of our firm's cost of capital, which we will look at in the next section, we can calculate a firm's economic profit. We also have the financial statements in a form that will assist us to identify the drivers or reasons why our firm has been able to generate the economic profit it has in the past. In other words, we are ready to start analysing our firm's financial statements by breaking them into bits. We have seen how to restate a firm's financial statements to clearly separate the operating and financial activities of a firm. This has allowed us to calculate Ryman Healthcare's 2020 net operating assets, NOA, of $4,036.3 million, net financial obligations, NFO, of $1,735.3 million, comprehensive operating income after tax OI of $273.7 million, and net financial expense after tax NFE of $21.0 million. Along with an estimate of our firm's cost of capital, which we'll look at in the next section, we can calculate a firm's economic profit. We also have the financial statements in a form that will assist us to identify the drivers or reasons why our firm has been able to generate economic profit, the economic profit it has in the past. In other words, we are ready to start analysing our firm's financial statements by breaking them into bits. 4.4. Profitability and efficiency. Information is not knowledge. Albert Einstein. In this section, we will use information from Ryman Healthcare's restated financial statements to look at some key aspects of its performance. We often think about profitability in terms of how much profit we make for each dollar of sales. A supermarket selling large amounts of groceries and other goods each day may make a profit of about 3 cents in every dollar of its sales. A luxury car dealer may make a profit of about $15,000 on each $100,000 Lexus it sells, or 15 cents for each dollar of sales. Which is better, to make 3 cents profit for each dollar of sales, or to make 15 cents for each dollar of sales? All other things being equal, we would rather make 15 cents for each dollar of sales. But all other things are rarely equal in business. What if a supermarket could make $7 in sales each year for each dollar it has invested in its business, in its stores, inventory and head offices? And our car dealer could make 50 cents in sales each year for each dollar it has invested in its business, in its car dealerships, inventory of cars and so on. After all, supermarkets have people going through its checkouts constantly throughout the day, often queuing up to pay the supermarket money. However, a car dealership can get rather quiet sometimes during the day and only make occasional sales of cars each week. In this section, we will analyse or break into bits a firm's financial performance into its profitability, how much profit it makes for each dollar of sales, and its efficiency, how much sales it makes for each dollar it has invested in its business. We will see one of the accounting drivers of a firm's performance can be expressed as return on net operating assets RNOA, a ratio of operating income OI to net operating assets NOA. This looks at the relationship between the earnings of a business OI and how much it has invested in its operating activities to make those earnings NOA. This is a relationship in a business many people can be interested in understanding. In this section, we'll look at how we can analyse a firm's return on net operating assets by breaking it into its component ratios of profitability and efficiency. Breaking things into bits. Analysis involves breaking things into bits. As he was growing up, my younger son was often curious about how different things worked. How does a keyboard work, or an old record player, or a watch, or a computer, or the dumb waiter in our house, or an old clock radio? He could not tell by looking at something from the outside, so he would often take it apart and pull it to bits. Although he did often find it more challenging to put things back together again, breaking things into bits gave him some insights into how things work. It is the same with financial statements. Are you curious about how a firm works? We will not physically break a firm into bits, but instead we'll break its virtual reality, its financial statements, into bits. We'll start with economic profit. We've seen that economic profit equals return on net operating assets minus cost of capital, all in brackets, times net operating assets, where return on net operating assets equals operating income divided by net operating assets. Economic profit is driven by or made up of 3 things: return on net operating assets, RNOA, cost of capital, and the amount of net operating assets, NOA, invested in the business. The cost of capital is often called weighted average cost of capital, or WACC, WACC, pronounced WACC, We will now start to analyse return on net operating assets by lifting the bonnet on the financial statements and taking them apart. We'll first break up or analyse return on net operating assets into a ratio that focuses on profitability, how much profit we make for each dollar of sales, and another ratio that focuses on efficiency, how much sales we make for each dollar invested in the business. As follows: return on net operating assets equals profit margin, PM, times asset turnover, ATO, where profit margin equals operating income divided by sales, and ATO equals sales divided by net operating assets. If you remember anything from this study guide, remember this relationship between profitability and efficiency. In many ways, it is at the heart of how we make sense of and analyse financial statements. Understanding this relationship and maximising the interaction between profitability and efficiency is one of the keys to success in any business. Accounting drivers. Ryman Healthcare's economic profit can be calculated as follows. Economic profit equals return on net operating assets minus cost of capital, all in brackets, times net operating assets, where return on net operating assets equals operating income divided by net operating assets. In 2020, Ryman Healthcare's operating income, OI, was $273.7 million. The company had net operating assets in OA on the 31st of March 2020 of $4,036.3 million, and net operating assets in OA on the 31st of March 2019 of $3,507.5 million. We can see Ryman Healthcare grew its net operating assets in OA a lot during the year ended 31st of March 2020. In fact, by $528.7 million. That is $4,036.3 million minus $3,507.5 million. That is a lot of growth in its net operating assets. Growth companies like Ryman Healthcare tend to be doing this sort of thing, that is, getting bigger. Children and teenagers can grow a lot in a single year, perhaps recorded by marks on a door frame at home. In the same way, companies like Ryman Healthcare are at the stage in their corporate life when they can grow a lot in a single year. At my age, I do not grow a lot each year, at least not any taller. That stopped a long time ago for me. But of course, there are more directions for us to be growing than simply upwards, particularly if we are chocoholics. So how do I calculate return on net operating assets, RNOA, for Ryman Healthcare? Return on net operating assets, RNOA, is a ratio that expresses the relationship between two numbers or quantities in a firm's financial statements. It is the relationship between operating income, OI, and net operating assets, NOA, namely return on net operating assets equals operating income divided by net operating assets. Operating income, OI, is quite straightforward. It is the operating income after tax for the year ended 31st of March 2020. In section 4.3 above, we saw how we can identify operating income, OI, from our restated income statement. But what about Ryman Healthcare's net operating assets, NOA? Which figure should I use? The figure for NOA, net operating assets, as at 31st of March 2020, or the figure for net operating assets as at 31st of March 2019. Depending on which figure we use, we can get very different numbers for our return on net operating assets, RNOA. For example, if we use Ryman Healthcare's net operating assets, NOA, as at 31st of March 2020 of $4,036.3 million, we can calculate its return on net operating assets as operating income divided by net operating assets, which equals $273.7 million divided by $4,036.3 million, which equals 6.8%. In other words, Ryman Healthcare earned a return of 6.8% in the year ended 31st of March 2020 on the net operating assets, NOA, it had in the business at the end of the year. But if we use Ryman Healthcare's net operating assets, NOA, as at 31st of March 2019 of $3,507.5 million, we can calculate its return on net operating assets as operating income divided by net operating assets, which equals $273.7 million, divided by $3,507.5 million, which equals 7.8%. That is quite a big difference. So which one should we use? The key to deciding this sort of thing is to remember that a ratio expresses the relationship between two or more numbers or things. In calculating Ryman Healthcare's return on net operating assets, RNOA, we are trying to get an idea about how much operating income, OI, the firm earned during the year ended 31st of March 2020, in relation to the amount of net operating assets, NOA, it had in the business during the year, generating that operating income, OI. For example, $273.7 million sounds like a lot of operating income to make in a year. But let us say a firm had $30 billion of net operating assets, NOA, invested in its business. In such a case, having operating income of $273.7 million would represent a return of less than 1% per year on $30 billion. This is not so good, as I could simply put my $30 billion in the bank and earn more than this, without taking on the additional risk and uncertainty involved in any business. In calculating Ryman Healthcare's return on net operating assets, RNOA, we want to compare its operating income, OI, that it earned during the year ended 31st of March 2020, with the net operating assets, NOA, that were used in the business during that year to earn that operating income, OI. If our firm's net operating assets has not changed much during the year, which can be the case for many firms, then we can simply use NOA, net operating assets, as at the end of the year as a good measure of our firm's net operating assets used in the business during the year. However, this is not the case with Ryman Healthcare. Its net operating assets has changed a lot during the year. Now, we know from Ryman Healthcare's balance sheet, both its net operating assets as at 31st of March 2019, the beginning of the year, ended 31st of March 2020, and its net operating assets as at 31st of March 2020, the end of the year. So which one do we use? Well, it depends. If on 1st of April 2019, Ryman Healthcare increased its net operating assets from $3,507.5 million to $4,036.3 million, and then had this level of net operating assets throughout the year, then we should use $4,036.3 million, the balance as at 31st of March 2020, because that is the amount of net operating assets that was employed in the business throughout the year to earn the company's operating income that year. Alternatively, if Ryman Healthcare kept its net operating assets constant until 30 March 2020, and then increased it suddenly from $3,507.5 million to $4,036.3 million on the last day of the year, then we should use $3,507.5 million, the balance as at 31st of March 2019, because that is the amount of net operating assets that was employed in the business throughout the year to earn the company's operating income that year. Sometimes it is possible to find out from the footnotes if there have been some sudden movements in a firm's net operating assets early or late in the year, such as buying a major new business, which can help us to decide whether to use opening or closing net operating assets when calculating our firm's return on net operating assets. If in any doubt, when calculating your firm's return on net operating assets, you can simply use closing net operating assets, particularly if you have not calculated net operating assets for the previous year. In the case of Ryman Healthcare, its growth in net operating assets occurred gradually during the year, as it continued to grow its existing business through building new retirement villages and through its existing retirement villages increasing in value progressively during the year. For this reason, for Ryman Healthcare, the best assumption to make about net operating assets is that it grew gradually during the year. So when calculating Ryman Healthcare's return on net operating assets, RNOA, for the year ended 31st of March 2020, I will use average net operating assets for the year. In other words, net operating assets equals opening net operating assets plus closing net operating assets, all in brackets, divided by 2, which equals $3,507.5 million plus $4,036.3 million, all in brackets, divided by 2, which equals $7,543.8 million divided by 2, which equals $3,771.9 million. Using average net operating assets of $3,771.9 million, I can then calculate Ryman Healthcare's return on net operating assets, RNOA, as follows. Return on net operating assets equals operating income divided by net operating assets, which equals $273.7 million divided by $3,771.9 million, which equals 7.3%. Now that we have calculated Ryman Healthcare's return on net operating assets, we can calculate its economic profit as follows. Economic profit equals return on net operating assets minus cost of capital, all in brackets, times net operating assets. We can use a cost of capital for Ryman Healthcare of 8% per year. This is an appropriate average level of cost of capital for listed companies internationally at present. You can also use 8% as the cost of capital for your firm. I've calculated Ryman Healthcare's return on net operating assets of 7.3%, used 8% as cost of capital, and also calculated its average net operating assets NOA for the year ended 31st of March 2020 of $3,771.9 million, which I've decided is the most relevant way of calculating net operating assets for Ryman Healthcare that year. I can now calculate Ryman Healthcare's economic profit for the year ended 31st of March 2020 as follows. Economic profit equals return on net operating assets minus cost of capital, all in brackets, times net operating assets, which equals 7.3% minus 8%, all in brackets, times $3,771.9 million, which equals 0.7% negative, times $3,771.9 million, which equals negative $28.0 million. Ryman Healthcare has 500 million shares on issue, so economic profit of negative $28 million represents about a negative 6 cents per share. This is the first year Ryman Healthcare has achieved a negative economic profit since it listed in 1999. Profitability. I find in business most people have a strong understanding of the concept of profitability. Most people have a clear grasp of the idea of profit margins, how much profit I make from each dollar of sales. There are several ways of measuring it and looking at it, but the idea itself of selling something to customers for more than it costs you, to buy inputs from suppliers and to transform those inputs in some way, seems clear enough to most people. Also, it is easy to grasp the idea that if you do not make an adequate profit margin, you'll quickly go out of business. Indeed, the concept of a firm's profitability largely cuts to the chase in terms of a firm's ability to add value to equity investors. It is in some way core to the activities of a firm. We define profit margin, PM, as profit margin equals operating income divided by sales, where operating income equals operating income after tax. The profit margin focuses our attention on the profitability of each dollar of sales. Clearly, the more profit a firm can achieve from each dollar of sales, the greater the value add to equity investors. The average profit margin in the US is about 6%, but can vary widely between industries and between companies within industries, and over time depending on where we are in the economic cycle. Nissim and Penman, 2001, page 129. For example, many firms can be expected to have profit margins, PMs, more than about 10% or less than about 3%. We can calculate Ryman Healthcare's operating profit margin for the year ended 31st of March 2020 from its restated income statement. See Table 4.8 in Section 4.3 above, as follows. Profit margin equals operating income divided by sales, which equals $273.7 million divided by $568.3 million, which equals 48.2%. As we can see, Ryman Healthcare's profit margin of 48.2% is very high. For every dollar of sales, it made 48.2 cents profit. There are not many businesses that can achieve profit margins like this. A key part of Ryman Healthcare's ability to generate a return on net operating assets of 7.3% lies in its ability to generate profit margins of 48.2% that year. However, it is only part of the story, and all parts of the story interact with each other. As I said previously, in business, I find most people have a strong connection with and understanding of the importance of profit margins in generating returns to shareholders. However, I often find much less understanding of the fact that profit margins are not of importance in themselves. Rather, it is the interaction of profit margins with efficiency, the amount of sales generated by each dollar of net operating assets invested in the business, that is critical. Efficiency. Efficiency is how well net operating assets NOA in a business are being used to generate sales or turnover. Turnover is another word for sales. It is measured as the relationship between assets and turnover, called unimaginatively asset turnover, ATO. We define asset turnover as ATO equals sales divided by net operating assets, where asset turnover, ATO, is the amount of sales generated by each dollar of net operating assets, NOA, in the business. It is the ability of NOA in the business to generate sales. Alternatively, ATO can be looked at as its inverse, 1 over ATO, which equals net operating assets divided by sales. The inverse of asset turnover, that is 1 over ATO, is the amount of net operating assets needed to be put in place in the business to generate each dollar of sales. An average asset turnover in the US is about 2.0 times, but can vary widely between firms and with many firms having an ATO between 1.0 and 3.0 times. Palapu and Healy, 2013, pages 5 to 25. Typically, a firm's asset turnover tends to be more stable over time than its profit margins, PM, although asset turnover can fall significantly for firms during economic downturns. A firm with an asset turnover of 2.0 times can generate $2 of sales each year for each dollar of net operating assets put in place in the business. Or alternatively, 50 cents of net operating assets are used by the firm to generate each dollar of annual sales. It is surprising how easy it is in business to overlook the importance of a firm's asset turnover. Return on net operating assets, RNOA, is driven by the interaction between profit margins, PM, and asset turnover, ATO. Return on net operating assets equals profit margins times asset turnover. This is the DuPont analysis of operating profitability, named after the major US manufacturing company that used this analysis in the early 20th century. See Chapter 3, Section 3.1. We can calculate Ryman Healthcare's asset turnover for the year ended 31st of March 2020 from its restated balance sheet and restated income statement. See Table 4.6 and Table 4.8 above, as follows. Asset turnover equals sales divided by net operating assets, which equals $568.3 million divided by $3,507.5 million plus $4,036.3 million, all in brackets, divided by 2, which equals $568.3 million divided by $3,771.9 million, which equals 0.15 times. Ryman Healthcare's ATO, asset turnover, is very low at 0.15 times. It can generate 15 cents of sales each year for each dollar of net operating assets the firm has in place in the business. This low asset turnover reduces the impact of Ryman Healthcare's strong profit margins, 48.2%, on its return on net operating assets, which is 7.3%. Profitability and efficiency interact to generate return on net operating assets. In business, many have a good grasp of profit margin but can often fail to fully appreciate that return on net operating assets, that is, operating profitability as a percentage of net operating assets, is not driven by profit margins alone, but by the interaction of profit margins and asset turnover. It is the interaction and trade-offs between profit margin and asset turnover that need to be the focus of attention in running a business. And maximising this interaction is a primary means for management to add value to equity investors. Conclusion. In this chapter, we got to know a firm's financial statements a bit better, more than we would at a simple first introduction. We've seen two ways of looking at how a firm adds value for its equity investors: cash flow and economic profit. These are two common ways of looking at a firm's value creation activities. We also saw a powerful way we can look at a business by clearly separating in our minds the operating and financial activities of a firm. We then restated Ryman Healthcare's statement of changes in equity, balance sheet, and income statement. We can calculate a range of ratios based on a firm's financial statements and based on its restated financial statements. One set of ratios will mix up a firm's operating and financial activities. The other will have these two aspects of a firm clearly separated. Using an economic profit view of value add in a firm, we saw how we could break up a key aspect of a firm's economic profit, its return on net operating assets, RNOA, into profit margin, PM, and asset turnover, ATO, using a firm's restated financial statements. So far, we've been looking at how people outside a firm can use financial statements to help them connect to a firm's economic and business realities. In the next chapter, we turn our attention to management and how people inside a firm can use accounting information to help them find out what is really going on in their firms.